What is going on, Internet? Eric Bandholz back again with another e-commerce conversations. I hope all is well on the other side of the Internet. On the other side of the Internet from me, Elrod. What's up, man?
What's going on, buddy? For somebody that's so jet lagged, you've certainly got a lot of enthusiasm.
Yeah. You gotta bring the punch to get going. I'm excited for this podcast. As you and I know, we know each other, and we're fellow rowers. And it's actually kind of, I've seen you outside of rowing, like maybe a handful of times, and it always catches me off guard not seeing you like in tights or a tank top.
It's a much more flattering image for to see me in real life rather than in rowing trowel, no doubt. So
Yeah, no, you're a good looking man, a great rower, I might add.
Not as
And
good.
I don't know about that. Well, why don't you tell I know who you are. Why don't you tell our listeners who the heck you are?
Yeah.
And what the heck you do?
And thanks for having me on this Friday afternoon and allowing me to bore you to tears and your audience to tears with a little bit about me and what I've been up to. But Chris Elrod, rower extraordinaire alongside Eric Bandholz on the Austin Rowing Club circuit. But aside from all the professional aspirations of rowing that we have, I've spent most of my career in the energy space, about 20 years now, mostly on the finance side. And literally within the last 7 years, and Eric, as you and I've got to know each other, you've seen me go through a couple different business life cycles, I'll call it. I started a couple renewable energy businesses, including 2 here in Austin. I started a solar development company back in 2018 called AP Solar. Had some partners in that, and we basically developed large scale sites for basically what we call utility scale solar photovoltaics that plug right into the grid. Basically power tens of thousands of homes, right? If we're doing our jobs right. And we successfully exited that business after about 7 years, my partners and I, and we ended up taking the money that we raised through those sale proceeds. We bought out some of the existing shareholders we had in that company. We ported the team over to another company that we co-founded, another renewable energy company called Trio Clean Energy, which is also headquartered here in Austin. We grew our team. We grew our sort of our mission to go beyond just the Texas market, where our predecessor business, AP Solar, was really focused almost exclusively in the Houston area, doing large scale sites. And we expanded our team heavily to do that. We expanded our market geography and footprint to do that. So we started that platform, Trio Clean Energy, in 2022. We ended up selling it to a private equity investor, basically funds that are now managed by a group called Macquarie Asset Management at the end of 2022. And so it's been a kind of a long journey of working at, in the early days of my career, large corporate, right, to being very entrepreneurial, sort of, literally the 2 guys in a truck sort of theme seems to ring a bell for me, at least, and probably my partners too. And then, as we've migrated from that entrepreneurial sort of mindset to now being back in the corporate, owned by private equity model, where I'm now sitting as the CEO and chief cook and bottle washer, et cetera. It's been an incredible journey. I'm very grateful to have had all the experiences I've had, but it's also been an incredible journey of growth and like learning along the way, right?
Yeah, well, what really amazes me in all of our conversations we've had over the years is just the scale at which you're operating. Like, and not only the scale and the size of these projects, but also your ability to build a team.
Yeah.
Really quickly. Can you give like you talk about serving 10,000 customers with
Yeah.
a project. So, why don't you give our listeners like a little bit more scale and you're basically building power plants, right?
Precisely. So, for example, for any one of our solar projects, right, that we're developing and now building and looking to own and operate with the support of our partners at Macquarie, we're basically taking thousands of acres of land, right? We're developing that land, we're entitling that land, we're then clearing, grading, and then constructing power generation infrastructure across that footprint, which then, depending on where you are in the U.S., right, in terms of irradiance and everything else, right? You're able to generate enough electrons to power a lot of homes, and that's usually the easiest example I can give to people. But the reality is, look, we're doing this because America, for the last 10, 15 years, frankly, is almost as long as I've been in the energy space on the electron side, we've had this like flat, anemic growth in electricity just until very recently. We just go turn the LED light bulbs, replace the inefficient incandescents with LEDs, all the energy efficiency stuff. That's been the easy money, right? But now we've seen this massive growth in AI and all the electrification, all the opportunities to onshore manufacturing, and we see the need for the juice keeps growing and growing. And so that's what we're really trying to solve, kind of on a sort of holistic basis. And so, it's these projects take time. To your point, they cost a lot of money. Their costs, are hundreds of millions of dollars of CapEx per project on average, depending on the size and other factors. And so, we have to be very thoughtful about how we, invest those dollars. We have to make sure we're investing them in the right markets and the right assets and so forth. And the only way we're able to do that, as you correctly stated, is we've got to have a best in class team to do
Yeah.
that.
Well, let's dig into this a little bit more. So, you're saying a 9-figure project that you're embarking on. How many projects are you generally working on, or do
Yeah.
you set goals as like, with this company, I
Yeah.
want to build 10 projects? Or
So this year, and all public information, I'm proud to say it. This year we'll raise about 1.2 billion dollars of third party capital to help us finance our kind of corporate level needs and our construction level needs. A lot, about 800 million of that is directly, or rather directed at project financing, right? Financing the construction and long term operations of our projects. That'll basically break up into two projects, or supporting two different projects. They're both in Louisiana. We have a third project that's already well under construction in Arkansas right now. And that'll bring, our 3-project portfolio up to, I'll use a technical speak in terms of megawatts, right? We'll be around 500 megawatts by the end of this year, which again, think about it, these are multi-thousand acre tracts of land that we've fully permitted title, we've cleared, we've flattened, we are putting solar panels on. And, like I said, we will raise, not all of the 1.2 billion will support that. That'll support some of the growth of our business, but a lot of that will support the investment and financing of those projects. And so there's got to be a number of things that align, right? When you're able to secure that financing, that level of financing, and we're by no means the biggest and baddest player in the business doing this, but you necessarily have to have all the right elements, right, for those lenders to get comfortable giving you that amount of credit capacity.
yeah, is that debt financing then, or I mean that's what it sounds like.
Yeah, it's debt financing. That's right.
Okay.
Yeah.
And then, like, are these 20-year terms, 100-year terms? Like, how does that even look and
Yeah.
work?
They typically have, like you're talking about, a long-term amortization profile, but the financings themselves are structured with a much shorter term maturity. So basically what the terms that it's called project finance is sort of the sort of catch-all vernacular. And within that sort of construct, they're underwriting to a stream of cash flows, right? That they're looking at saying, okay, I'm going to get repaid with this long, solar right now, based on warranties, based upon where the technology has evolved, it's a 40-year useful life asset. Batteries is another technology that we invest in and deploy. We'll be deploying next year a couple exciting battery projects in Houston and in Georgia. But those are 25-year useful life assets, right? Just based upon the cell degradation and so forth. Solar PV is 40 years. And so, we've got theoretically a 40-year useful life asset that should make money over 40 years, right? And so the lenders look at this, they're not going to look at 40 years, but they're going to look at, say, 18 years. And they're going to say, yeah, like worst case, even if you don't refinance me out, right, and I had to step into this project over that 18-year period, I'm very likely to get all of my money back, right? That's a simple way to think about it. Now, of course, we have to refinance them typically in sort of year 5 or so after we go operational. And again, assuming the financing part, yeah,
What's the intent with the refinancing?
yeah,
Is it
it's sort of basically giving the lenders the ability to exit the project,
okay?
because the way that their funds are structured, right, is these are sort of longer dated interest rate instruments on the one hand, where we've got a fixed interest rate. It's think about it, we don't really get a lot of benefit when they talk about lowering the federal funds rate, because that typically is applying to like the 3 month, sort of overnight rates that the Fed can control. We typically benefit when there's a longer term, or rather a reduction to the longer term interest rates. And so these banks are basically saying, we don't want to be in it for 20 years, 18 years, right? We want you to take us out. And so we will get some of our money back during that mandatory maturity period. But at the end of that maturity period, you got to take us out, and you got to, frankly, the way that happens is very common, is you just go refinance them with other debt, right? And you basically keep extending on that same amortization profile.
Okay.
Yeah.
And they're banks that are doing the financing then?
Yeah. Yeah. Exactly. A lot of European, Japanese banks, right? They're large commercial banks. They're really invested in this stuff.
Yeah. How do you get those introductions? Like, I know you've done this
Yeah.
before, but like,
Yeah.
you just show up and knock on the door and be like, "Hey, I want $1 billion."
Put on a nice suit and tie, make sure I've got the right, product application going on. I get a
Some
clean
beard
shape.
brand products in
Yeah,
there.
yeah, exactly. And then, go begging. No, I think, part of it is, the existing relationships. We've done it before, but a lot of it, frankly, is the partnership we have with our shareholder. They've got a fantastic brand, and they help us with a lot of this kind of, I'll call it capital markets, activity. So that was frankly part of the calculus, right? Even rewind back to 2022, and we did our deal with them. It's like, okay, what resources can they bring outside of just money to the equation, right?
Yeah. And now, like a single deal, are you trying to work with a single bank, or or are the banks looking to be like, hey, I want to be in with like, HSBC Bank and
Yeah, they'll club up, right? We'll either in the instances that we've done thus far across 3 projects, right, we've formed clubs of lenders. So, we've asked lenders to kind of think about take an equal slug of the debt capital, right, in the financing we're trying to do. So they just kind of divide everything ratably. But one of the real common sort of ways to do it right now is to basically have an underwriting, and you would a lot of times, lenders can underwrite to a much higher, sort of ticket size. And maybe you need instead of like 5 lenders, like we have in these 2 projects we're trying to do right now and trying to close right now, we might have like 1 or 2 that would underwrite, and then they would syndicate it. Now you're paying them to do all that work, but that is sort of a more efficient way, I would say, from like a time management perspective, that might result in a maybe faster velocity of getting this stuff done. We of course have been trying to be very scrappy, and trying to capture value, in doing this a little bit more I guess the hard way.
and what is the choice between debt financing versus equity?
Cost of capital, right? Even though interest rates, as I mentioned, we're gosh, here we are. The longer term rates are still, obviously a few hundred basis points higher than they were even back in 2022. And that's really, for businesses like ours, infrastructure businesses that rely on this kind of, debt product, it's meaningful for shareholder returns, right? On the one hand, at the same time, the shareholders, have a premium that they command above, like the debt markets, right? And it's still efficient, or more efficient rather, capital efficient, to be sensible in using third party debt capital where possible.
Yeah. And, at this level, I feel like in your scale,
Yeah,
you really have to be involved or aware of kind of like the geopolitical things
yeah,
that are going on. I mean,
yeah,
you've already mentioned like the Fed rates and
yeah.
kind of like the macro turns. Like, how do you prepare and plan for that when you honestly don't know the future? Are you trying to take like big bet risk where it could really give you a competitive advantage, or is it more of a hedging and kind of
Yeah.
a conservative strategy?
Yeah, great question. I think we certainly, I spend a lot of time, thinking about the macro environment, right? Thinking about not just interest rates, but thinking about tariffs. You and I've talked, on and off about tariffs, right? And you know, um, there's I'm sure we could debate for hours about, maybe there's reasons to have strategic tariffs and things of that nature, but like, doing sort of blanket tariffs and other forms of tariffs, especially upon, products and things that the U.S. really has no ability to create or wants to create, no control of any upstream or raw material supply chains to support. It's tough. It makes doing business really tough. And then add to that the uncertainty of what that tariff will be next year or, in over time.
or
These are
next month.
yeah,
Yeah.
next month or tomorrow.
Yeah.
I was a little bit worried last Friday, right? We were going to have 100% tariffs on China
Yeah.
after November 10th. Now it's apparently we're not going to, so which is great. Happier for that. Um, I think that it's, to me, you're playing that tariff volatility game is really tough. So what your point is like taken, like, where we can, right, transfer that risk to third parties, whether it's, our customers or oftentimes it's to a supplier, right? We're trying to pull that lever. On the other hand, frankly, it's just forcing us to be really opportunistic. So if we're seeing, paying attention to the news, right? Really concerned. We've got all sorts of consultants and lobbyists that we're trying to get insight and intel from, concerned about a tariff coming in at the end of this year, right? Maybe we want to go ahead and lock in some commodity or equipment now, bring it even across the US border now so that we can try to keep the costs lower for our ultimate customers. Um, it's just being very, very nimble and opportunistic. It's probably not a great strategy. I don't know if that's a strategy, right? That's just being almost like, you know, how you have to survive and react.
Yeah, yeah. I mean, because I mean, frankly, like let's say, I would imagine the majority of your cost are in the physical assets, right?
Yeah.
They're in
Yeah.
the solar panels.
Yeah.
Um,
Panels, racking, right? We've got,
yeah,
steel pilings we put in the ground to support the racking. We've got, copper wiring cables, right, in our cables, and we've got aluminum. We've got all sorts of commodity and engineered equipment that's, some of it can be made here, right? And more and
yeah,
more of it will be made here, which is great. But a lot of it can't be made here or it can't be made here at the quality or at the cost that it can be made elsewhere.
yeah. Or the speed.
Yeah.
To
And certainly there's no, existing manufacturing or,
right.
production line to do that.
So like tariffs, 100% tariffs, completely change that whole business
Yeah.
model. Like, would you, cases like that? Let's say you can't get the good ends. Do you try to renegotiate the deal, or do the numbers just
Yeah.
stop working? Because
Yeah.
like solar alone is a pretty, it,
Yeah.
in my opinion, it's a great energy source. It's
Yeah.
about as friendly as you can get, but
Yeah.
it's not as efficient as like a nuclear or
Y yeah, yeah, certainly, like, it converts, the visible light spectrum, right, at a mid 20% efficiency level, okay? And then there's additional losses as you take those DC electrons and convert them to AC electrons and, send them onto the grid. And, I think that, um, however, it's still very cost effective, much more cost effective than nuclear today to consider building, for example, a PV plant, even a PV plant with coupled storage, right? To kind of even create a firmer profile of that energy source versus building new nuclear today. And so I think for us, like you said, the tariff risk components within that cost structure, we don't want to wear that risk and promise a customer something and then all of a sudden we're upside down and we can't deliver. So fortunately, thus far, we've been able to, through structuring our kind of contracts with suppliers and whatnot, like we've been able to work with our customers and keep them at a price that we've agreed to, for example, at the beginning of a contract negotiation, right? And we're pretty proud of that. But we'll have to make sure we continue to deliver on that because at the end of the day, we don't want to expose our customers to that. So, like I said, it's all about being nimble, all about finding ways to manage that supply chain risk and doing that in a thoughtful manner that de-risks it not only for our shareholder but also for our customers.
who are your customers then? Like
Yeah.
the paying.
Yeah, it's think of
Right.
it, corporates that want to, procure that need to procure energy, frankly. They need to procure clean energy. So, hyperscalers or other large, industrial companies that have a desire to, grow their load, right? And they want to procure ideally um clean power. Clean can also be a number of things, right? But at the same time, right now, the way to, the fastest power to procure on the system today is going to be solar PV and potentially solar PV plus batteries.
Okay. So these customers aren't going to be like your typical residential,
Yeah.
you mentioned like 10,000 homes, but
Yeah.
it's actually going to be like,
Think of it like the utility company that manages all those customers' meters, right? And they're sort of aggregating all that load and looking to the generator to supply through their kind of utility procurement construct. That could be one customer. We have a
okay.
number of utility customers that we work with, like in the Southeast, for example, like,
Yeah.
your home state, right? We're working with a number of your former utility players. Um, but then, yeah, we're also working directly with the corporates and the
Yeah.
hyperscalers, right?
So like, Elon built like the Colossus over in
Yeah,
Memphis and they
yeah,
wanted, for an example, if they wanted
yeah,
some clean energy, they
yeah,
would be one of your customers.
yeah. I think, yeah, the United States is really interesting. It's basically just a amalgamation of different grids, right? There's essentially an East grid, a West grid, and then a Texas grid. So there's like three distinct grids in the United States. And within those grids, there's all sorts of what we call balancing area authorities that are basically like, fiefdoms, right? Of utilities or other, grid operators, right? That control the flow, who gets on the grid, who gets to draw power from the grid. And, just speaking of like the West Memphis Colossus, facility, I don't know if that's like Memphis or City of Memphis or Memphis Power and Light. I can't remember what the municipal is there. If that's like Tennessee Valley Authority, but like just in that rhetoric alone, right? It's like you can imagine how difficult it is to actually then go and say, okay, even if they wanted to procure from, say, my just across the river, Mississippi River into Arkansas, where I've got a PV plant, they have to they'd have to work it out with all sorts of other utility constituents, perhaps, right? So
Yeah.
it's
So you can't build like a private,
yeah,
off grid
yeah.
energy
You
farm,
could
could
in
you?
Texas. You could build a
Okay.
private use network in Texas. Like, it's been done before. I think Shell has done something like that for one of their refineries or something on the Gulf Coast. But like, I think outside of Texas, it's challenging.
Yeah.
Yeah,
How, I want to talk about a couple things there.
yeah,
You know, you've got the sales element to that.
yeah,
Who's handling that? Are you building out a sales team or are
yeah.
you also knocking on
Yeah.
the doors?
Well, yeah, I support them, but really we've got what we call a power markets team that's focused day in and day out on identifying those customers, engaging with those customers, figuring out what they are looking for, um, submitting to customer RFIs, right? Customer RFPs, submitting our projects into them, and managing all of that interface and procurement process.
Yeah. How big's your team currently, if you don't mind me asking?
Yeah, no, I think, gosh, we just had our offsite on Wednesday, our quarterly offsite. I think I counted just over 100. If I get
Yeah.
specific, I'll probably get it wrong, but it's certainly north of 100 now. Um,
So I wanna pick your brain on like how you scale up your team to
yeah,
add. I mean, that's over the course of what, 2 years? You added 100
yeah,
people, or
yeah, that's right. We were
I
about 17 when we sold the business to Macquarie, and yeah, now we're just over 100.
yeah. So how do you are you a culture oriented
Yeah,
guy? And like how are you able to maintain the culture as you go from 17 to 100?
yeah. Yeah, that's a really good question. Yeah, we are absolutely we have a culture playbook at Treaty Oak. We've got a set of what we call core values or fundamental values that we've developed. But the biggest thing that I've been sort of, um, kind of trying to, impart on our team, especially as we grow our team and as we have different levels of experience on our team, is it all comes down to executing with excellence, right? And um, for me, that basically means that I'm going to be committed to being eternally vigilant, right? And I asked our team to basically make the same commitment, right? And so that's for the new folks and that's for the existing folks. And I'll be honest, like I always, try to continue to think about lessons learned and how to get better and how to improve, right? And I think like right now, based on what we've learned over just the last 2 years, and by the way, and I don't, your experience is probably, I would imagine, somewhat similar. The labor market itself has been incredibly employee friendly, probably since COVID, right? COVID had a massive distorting effect on the supply and demand of labor. And so we were sort of thinking about hiring and starting a lot of our hiring plan just after, 2021, 2022. And, we started, especially in our industry, we got some stimulus from the Inflation Reduction Act that kind of sent probably a lot of inflationary pressure, in fact, to the industry in terms of at least labor costs in a number of other areas. And so we've seen a significant increase, let's say between 22 and 24, even of how difficult it is to attract and retain talent. And we needed that talent. So we found ourselves in a position of truly trying to, if we found talent, we were, okay, how do we attract and retain them? One of the things we've learned in the last 12 months is really, we have to design, like, for example, scorecards, especially for our senior roles, that really kind of lay out the key criteria of what we're looking for in that resource, right? And be very judicious about ensuring that those candidates are in fact, ticking the boxes on the scorecard and performing well against the scorecard. Because I will tell you, like, you know, um, having that mentality of like butts in seats and just, getting the resources is not a winning strategy for building a business that is going to day in and day out pursue execution with excellence.
Yeah. Let's talk about that
Yeah.
scorecard. Is this built on EOS or any other? Uh,
We sort of we've got a people and culture team or HR team that manages that, and we basically are looking for them to work with the hiring manager, work with some of their peers to establish, okay, what are the key criteria that we're looking for from this individual in terms of this role. And oftentimes that's aligning with, one of the other tools we use, with our team in terms of both performance evaluation, but also just in terms of like, all of our managers are sitting down at a minimum quarterly with their reports. And we're kind of seeing how we're stacking and tracking against company OKRs on the one hand, because everyone has some, part of their bonus is tied to company performance, even at the lowest levels, right? And on the other hand, it's about total transparency to those objectives, right? I'm talking a lot to our company around how we're doing relative to our company scorecard, which is where my performance gets measured, right? So it's from top to bottom. It's an entirely transparent process. There's no hiding what we're all trying to solve for. On the one hand, on the other hand, like I said, if you've done the investment in the scorecard, and you've got the right scorecard, and you've developed the criteria, thinking about how you're going to use that role to further deliver to your OKRs as a functional leader, as a senior professional in the business, you're going to make the right hire. And then that hire is going to do the right job. And so you're going to have really constructive reviews with that hire, right?
how long does it take for you to really know and feel confident that you've built the right
Yeah.
scorecard for the team members?
Yeah. Well, I'd say it's we sort of find out, if you will, within the first 90 days ish of when somebody joins the company. How well we sort of match them with the scorecard. And then from there, okay, we can oftentimes, at that point we can determine, okay, this is going to be somebody we can work with for a while, or, maybe we have to rethink it. We had to rethink it, candidly with a senior leader within about 6 months, just because we hadn't designed the scorecard for that role yet, and we hired this resource and we weren't able to align with them in terms of what we needed. And so it's and all of this is to say, like, just being really intentional and thoughtful about what you need from a resource before you're going out to the market and looking for that is really important.
Yeah, yeah. Now the last company, you built it, you sold it.
Hmm.
You know, is you're funded by private equity, right?
Yeah.
Is the goal for private equity also to see their return on investment within a certain period of time frame?
Yeah, absolutely. I mean, that's going to be, I think, a goal for any investor, and we are in constant communication or dialogue with our shareholder about profitability and performance and kind of where things are tracking and where we're projecting things to go in the next year and then in the coming years. Um, I think we benefit from one of the other, I think, merits of why we wanted to sort of enter into that transaction in December of 22 with Macquarie. They actually have what's called open-ended funds that we sit under, and so think of it as almost like they could continue to invest in our business forever. Right. They'll keep going to, raising new capital into those funds. They'll keep deploying that capital into businesses like ours that they control. And that's really exciting for us because, as I mentioned, we're investing in and owning these long-lived assets, and we want to keep doing that and building that and growing our asset base, right? So that for me is a really exciting feature of our shareholder ultimately and how they're structured. That's not typical because a lot of the investors in this industry that in infrastructure and certainly renewable energy, they're sort of in these closed-end funds where they've got to return money to their shareholders or to their limited partners at a fixed date. It's typically, call it 10 to 12 years, maybe 15 years after they've closed the fund. Um, so we feel like we're well positioned. We're not going to have to be like, forced to sell or forced to sell our assets at any given point in time because we have this open-ended fund structure that sits above us.
And your projects are built in a way that they will be profitable
Yes.
upon completion.
Yeah.
So there's like that opportunity for like a dividend kind of.
Yeah, exactly. That reoccurring dividend, that's a really important point, and that's a really good point. It's part of our sort of value prop, if you will, to our ultimate upstream limited partners is that, we will generate, cash flow, right? And we will return to them over the years. Um,
What is this is your second one. There's always the joke like the first business. I assume this is your second one, right?
yeah. Well,
Yeah, yeah.
well, this is the sort of second, I'll call it,
Second run.
yeah, kind of principal investment business that we started and then, have successfully monetized or led or managed, right?
Yeah.
We did some consulting businesses in the past and some other things, but yeah.
The joke I hear from people who raise money is like the first one, the investors make all the money. Like the second one, you kind of break even, and then it's the third one that you as the operator actually
Yeah.
make money.
Yeah.
Is that kind of the gut feel that you have? Do you want to do a third, or do you want to ride this one out? Or I mean, like, what is kind of
Yeah.
your perspective on that statement?
Well, I think that, I'm really proud of, we were able to structure on our first sort of development company, we were able to structure a really a kind of a win-win for us as management, but also for our sort of think of it almost sort of friends and family shareholders that we ended up getting some capital from, and everybody frankly made multiples on their money, and it was a good outcome, right? Um, I'd say that fast forward to where we are today, what I'm most excited about is in fact the long term profile of this business and sort of sticking with it for the long term. That's certainly important to me to actually build something here, to actually build something that's of worth and of value on the one hand. And it's helpful that, again, don't have to be forced to sell anything anytime soon. And yeah, I'm just going to keep plowing is kind of
Yeah.
how I think about it. So the third business, I mean, I look at it almost like, well, Treaty Oak should be able to think about all these additional businesses that it can go and ultimately grow into or acquire if we're successful enough, right? Because we have the right capital behind us and we have the track record of delivering and being, excellent in our execution.
Yeah, and you're not getting that pressure from
Yeah.
your private equity to
Yeah.
sell and move on.
Yeah.
That's pretty interesting, and it's kind of interesting, circling back to the beginning of the call where, your vision seems a little bit bigger. So it's like beyond Texas.
Yeah. Exactly.
Is it still within America, or do you
Yeah.
see global growth opportunities?
Yeah. I mean, Look, in spite of all the macro kind of noise, I'll call it out there, America, I think, is still got a really compelling value proposition. There's so much opportunity here, so much demand here, whether it's for electrons and what we do, or consumer packaged, goods and other product, like, right. There's so much of capacity for this market, and so I think there's plenty for us to do in the U.S. for a long time. And frankly, I also just selfish. I just don't know enough about other markets out there, other countries and their energy grids and things like that. So I think we're gonna have a long term trajectory here in the U.S. and have plenty to
Yeah.
do.
Where can people reach out to you, follow you, get advice for you, row with you?
Yeah, come down to ARC and hop in a boat, man. For
Yeah.
sure. I'm pretty weak on the socials. I have to be honest. I got a LinkedIn account,
There you go, man.
but I think, yeah, certainly, check out the website. I think we gave that to you. And yeah, shoot me a note on LinkedIn. I'm always interested in making new contacts.
Yeah. Well, thanks for coming on the podcast and sharing your end of the week with me. I
Yeah,
hope you enjoyed it as much as I did. I find it absolutely fascinating to see what you're building and how you're building it.
yeah,
And you're, of course, someone who I admire. I think you do it the right way, the hard way, in the impressive way. So,
yeah. Thanks, dude.
thanks,
Thanks for
thanks
having me,
for,
man.
yeah, man. Thanks again for everything. Hopefully, our listeners enjoyed it as much as I did. Cheers.
All right, bud. See you
Keep
soon.
on growing.
Bye.